Welcome to the weekly update, where I'll go over the action in the market for the week of April 21st through the 25th, and we'll see how things look for the week of April 28th through May 2nd. Had a pretty solid up week. Now, in the short term, we are looking positive. Over on the daily side, the charts are improving. We're above the 20 period moving average, so that switches us over to a short-term uptrend, but we're still negative in the intermediate term and the long term because we're below the 50 period moving average for the intermediate term and the 200 period moving average for the long term. And we're still looking more negative, but showing signs of improvement here on the weekly side. So we're in a range, and right now we're actually looking possibly a little overbought in the short term, and we're kind of coming up to that high end of the range. We're back above 5,500. Now, it was very impressive that on Monday we got down to 5,100, and we've been able to climb above 5,500 in 1 week. So, yeah, there's some improvement. Now, even though there's nothing really substantial that's coming out about the tariffs and the trade wars and all that, the market's kind of treating a lack of bad news as okay, things are not as bad as we thought. And so maybe we can come in and do some buying because we're really overbought, or excuse me, we've been oversold now for quite a while. Long-term support is still holding, that I'll show you, but we'll have to see. Can we build on these gains that we saw over the last week and start to shift things back more positive? All right, before I get into this, please know that I do videos every day. I post them on YouTube and Rumble, but they are delayed. Now, if you want to have immediate access to the videos, I'm going to be rolling out a service pretty soon where you can join a membership and you'll get immediate access to the videos. Also, I do a daily and weekly newsletter as well as some podcasts. And if you want to be a member to get access to the videos, the daily and weekly videos, you'll also get access to the daily and weekly newsletter as well as the podcast that I do. The idea behind that is that the podcast is 4 or 5 minutes every day. And then you listen to that. It's just voice only, and I try to edit it and take out all the fumbled words and the clearing my throat and all that. And you listen to that and you say, okay, I might need to do something today. So let me go over and read the newsletter. And that's supposed to be, 5 to 7 minutes. I have some important charts on there. I try to really break it down and make it quick. And if you say, okay, I still think maybe I need to do something today, then you can go over and watch the daily video. And so that's kind of how I'm trying to work this out. Now, if you're a member in the program, which I do have, you get a lot more than that, but you do get immediate access to all these other things as well. Also, there is a PDF below every video that I post. Some folks watch this on a smartphone or some kind of a tablet. You might have trouble seeing things when you're watching the video. It might be a little bit clearer if you look at the PDF where you see the slides and all the charts that I use. Here is a link to the SPX investing program, which is the program that I have. You're welcome to check that out. It's still free. It's still free, at least for a little bit longer until I actually lock that down. And even after it is locked down, you'll have probably about a 30-day trial to check that out. So feel free to just look it over and see if it's something that might help you. Also, I do post pivot points every day on the YouTube community tab. I can't do this on Rumble. And there are two charts. There's one that is a monthly chart, and I just update that with each day's new bar or candle. Then there are intraday pivot points, and you'd be surprised at how accurate these things are. Feel free to check those out and see if they're useful to you. I do have a private Facebook group, as I say every week, not really active, not a lot of members. If you want to join and change that, I'm on Facebook all the time. So if you message me or want to join the group, I usually respond to that in a very timely manner. I really go through and watch YouTube and Rumble comments, especially Rumble comments. I'm getting all kinds of crap comments and social media experts and It's all scam stuff, and I delete all of that. But if you have an honest comment that you want to put up there, you are more than welcome to do that. Even if you disagree with something I said or a conclusion that I've reached, feel free to do that. That's what they're for. It's not for all the bots and all the scammers and stuff like that. I just soon have those folks go away because I put an email address in every video and the people say, "Oh, great content. I love your videos." Well, if they actually watch the videos, then they would see the email address and they would contact me that way. They're not doing that. So they're lying to me right off the bat. And if they're lying at the beginning, what are they going to lie about after that? Okay, and then I do post on YouTube and Rumble. Okay, so for the week, we were up 4.59%. That's a pretty hefty advance, especially when we were down as much as we were earlier in the week, especially on Monday. We were above average with volume, which is strange. When you look at the daily charts, we've been below average with volume every day. But when you look at the weekly charts, it actually shows that volume picked up to above average. And we are looking more vulnerable, even in the long term. We're seeing some negative signs here. We have to start over in the short term on the daily side, see that improve, which is improving right now. See if that can bleed over into the intermediate term, which is improving, and then eventually feed over into the long term on the daily side. And then once the daily side starts to improve, then we can jump over here to the weekly side. I mean, there's a lot of variables right now, and the market is quite vulnerable. Some kind of news comes out, it's fixated on all this tariff stuff and these trade wars and everything. And okay, we've had kind of an absence of that over the last week, and the market has been showing signs of life. And it could get a lot better from here, but it also could get a lot worse from here. And these are things that are kind of out of our control. We look at the charts, we evaluate where things are at, but some kind of news event comes in and we're positive in the bigger picture because our long-term trend is still holding up. That's a secular trend. But in the short term, we're more vulnerable. So we could get hit either way. What I've noticed after decades of studying the markets and being involved in them is when we're in a downtrend, that tends to be when bad news happens. When we're in an uptrend, that tends to be when good news happens. Well, we're kind of in between right now. We're in the middle. So we are showing some vulnerability as far as the technicals. We are seeing interest rates coming down a little bit. The 10-year yield bonds seem a little bit more under control now. They're more stabilized. And we've actually been declining with the 10-year yield, which could end up helping stocks. We will get some more inflation data this week. We're going to get another look at GDP, which has an inflation component. We're also going to get the core PCE, which is the Fed's preferred measure of inflation. And then we're going to have the all-important employment report on Friday, and that could be very telling. So far, the employment situation has been holding up. Weekly jobless claims, continuing claims have pretty much been level. In fact, initial claims are actually going down, and that shows strength in the employment situation. That's what we're watching to see if we're going to go into a recession, and that kind of feeds into this recession debate area. It's likely that we might end up in a recession. But one of the areas that we're watching is employment, and that's holding up for right now. If that really starts to take a dive, then you might lean a little bit more towards, okay, we might go into a recession. But for right now, the market's not really concerned about that. There are some deflationary issues going on, but they're not really worried about interest rates or inflation right now. But we're kind of in between as the market is trying to figure out what's going on with all of these things. Plus, we're right in the middle of earnings season, and especially for the S&P 500 and some of the bigger companies. Some have already reported, some still have yet to report. And if they're a really big company, that can have a pretty big impact on the S&P itself. As far as our trend, we're still negative there, and it shows that we're getting a strengthening negative trend. The red line is above the green line, and I'll show you that chart there. Okay, so here are some bullet points. We did have a really strong week. We were up 4.6% with the S&P. Now, it says here exited out of correction territory. I get this information from briefing.com. According to my chart, we're still down over 10% from the all-time high. So I still think that we're still in correction territory. But you're kind of splitting hairs with that. And then we've been able to rise 10.9% from the low that was set back on April 8th, which was at 49.8277. That's pretty impressive right there. And then the NASDAQ was up 6.7% for the week, and the Dow just a mere 2.5%, which is a really good gain compared to what's been happening lately. Then we did have a very weak Monday, and there was this idea that President Trump, they're gonna like, okay, let's fire Chairperson Powell from the Fed. And then this created more upheaval because the Fed is supposed to be an independent part. Now he's appointed, in fact, it was Trump who appointed Powell. It's not like they're golfing buddies anymore these days. They don't really seem to care for each other all that much. And Trump is a businessman, so he's going to make comments from a business angle. He's not a politician. And he's not going to say things that, where you say a whole lot of words and end up not really saying anything at all of substance. And that's one reason why he's so polarizing, because he says what he means and he means what he says and he does what he says he wants to do. And he's looking at America from a business standpoint and saying, hey, cut those rates or get out of the way and we'll put somebody in there that will come in and cut the rates. All right, that was creating a lot of hubbub earlier in the week. And then China came out and said, yeah, if any of these other countries that do trade with the US and we also do trade with you, we might retaliate against that. And this pressured trade negotiations. So it didn't get off to a good week right after Easter. Then later on in the week, Trump came out and said, nah, I'm not going to fire Powell. He's a great guy. He's the greatest guy ever. He also indicated that he won't play hardball with China, but he really is. If you read this, said that China's tariffs rate will come down substantially, but not to zero, if a deal can be reached. What is negotiating? It's reaching a deal. So he says he's not playing hardball, but he's a negotiator. And when you negotiate, you play hardball. All right. Then we did have some upside bias that, yeah, there was some short covering. Now, there were some long-term, very bullish signals that were triggered, especially on Thursday, that some folks are already dismissing as, well, this was just short covering. What happens when they're short covering is these are people that will make money if the S&P or any market goes down. And what they're shorting the market. And what they have to do to get into their position is they have to sell. And I know that makes no sense if you're kind of new to the market, but you sell to get in with the idea of being able to buy it at a lower price. And then that's your profit there. Well, if things go the other way and start going up, you've still got to buy to get out. And if you got a lot of people that are short the market who think it's going to go down and it starts going up, we see all this buy, 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 buy. They're not buying because they think the market's going to go up. They're buying because the market's going up and they have to get out of their positions. And that's often called a short cover rally or a short squeeze. And that can really drive prices up. Now, we might have seen that earlier in the week, but I'll go through the chart. It doesn't really look like we were seeing that later on. And some of the longer term bullish signals that we're seeing, I wouldn't necessarily just chalk that up to short covering. There was some authentic buying going on, and we saw some real improvement. But at the same time, we're going to have to see follow through for this improvement to get some legs behind it and really turn things back more positive. The mega caps, they had a pretty good week. They were up 7.4%. Then we also saw the growth areas, and this is what's been really dragging in 2025. Discretionary and tech and communication. Those are three big growth areas, and they've been really lagging. In fact, they're in downtrends, and they've been underperforming value. They really bounced up. Now, they're still negative, but they are improving. We saw tech up 7.9%, but still in a downtrend. Discretionary up 7.4%, still in a downtrend. That's Tesla and Amazon there. And then communication, this is up 6.4%. These are the three big areas that really drive the market up. So, yeah, it's nice that they bounced, but can they continue to bounce? Then there was a lot of earnings. We're right in the middle of earnings. Even though Tesla came out with a dismal report, Elon came out and said, well, maybe I'm going to kind of step away from Doge a little bit and maybe go run this company called Tesla. So that ended up being up over 18% on the week. The earnings report was bad, but him coming back gave folks some optimism there. And also Google reported, and they were up 6.8% after they reported their earnings. And we also saw a decrease in yields. As I said earlier, it looks like bonds are getting under control. They're more stable now. And we ended up being down to 4.27%, where a week ago we were at 4.33%. I think that's what it was. So we're coming down. It's still at almost four and a quarter, higher than a lot of people would like it, but at least it's headed down instead of massively going up like it was a couple weeks ago. I show this chart every week, not because I think this is what's going to happen, but just because I want us to always keep this in the back of our mind. This is inflation or CPI from 1966 to 1982. And it was going along pretty good. You got the late 60s, early 70s, and then we started to really go up with inflation. This was the first gas crisis. If you remember those times or read about them in a history book. And then we saw inflation really coming down. And we're still kind of in this area about 1977 or so, where inflation has been more or less coming down. What we're concerned about is look what happened after that. Now, I'm not saying that's what will happen now, but it could. The reason I keep showing this chart is because people think that the way things are right now is the way they're always going to be. They can change. And so we went from a pretty low inflationary environment to a super high inflationary environment in a pretty quick period of time. This was called stagflation, which is where you see super high inflation with pretty much no economic growth. Before we saw a change in administrations in the early 80s, and President Reagan did some things that helped to, and Volcker was head of the chair or the Fed chair at that time, and inflation really started to come down. But it was pretty crazy times. I grew up during that time. So it could happen. It could not happen, or it could be some variation of what we see here. We just always want to keep that in the back of our mind, keeping a respect for the bigger picture, knowing that things can change. We are still above 4.02%, which according to RenMac, when we're above that level with the 10-year yield, that's when we see corporate profits coming down. And we spent a lot of time above 4.02%. And so what have been happening with earnings? They're still positive, but they're being revised down. And that's been a lot of the pressure in late 2024 and into early 2025. That's why when we set the all-time high in February, it just kind of fizzled out. We didn't really spike up and have a blow off top or anything. We just went and set a new high and then just have been drifting lower and then started marching lower with some real conviction as we finished out February, March, and got into April. This won't be updated for another week. This is updated when the employment report comes out. And then here, this is looking at another rare and bullish breadth thrust. This is similar to the ZWAG NYSE breadth thrust, which I'll go through later. But this is, you see over 70% of advancers in the S&P for 3 days in a row. And that's what we saw Wednesday, Thursday, and Friday. Now, Wednesday was a little bit off. That was really more of a negative day than a positive day, even though we closed higher. And I'll show you the chart here in a moment. But looking out 1 month, 3 months, 6 months, 12 months, we see pretty good success rate, all the way up to 96% going out into the future here with really good returns along the way as well. So a lot of times how we shift from being negative over to positive is with an upthrust like this that we have seen. So there are some positive things out there that we can possibly build off of. We are seeing it coming down, but bouncing up a little bit when we look at stock positioning right now. When we go below zero, that means more people are selling than buying, and we're starting to get extreme. And this is matching up with some other lows, and now we're starting to bounce up from that. Then, according to Deutsche Bank, nobody really knows for sure, but they crunch some numbers, come up with a few spreadsheets, and then put it in some kind of a graph here. They think that the tariffs are going to have an impact on the earnings per share for the S&P, and they could actually help the earnings per share. Nobody really knows. Everybody has an opinion, but nobody has really any facts because these things haven't really started to happen yet. And so people are trying to guess what they think is going to happen. Deutsche Bank thinks that it's going to have a negative impact. And The S&P posted its longest win streak since January. Well, January was just a few months ago. It's not like, woo, we haven't seen this since 1927. No, it's just been a few months that we had an up week. All right, and then this is kind of interesting too. At the end of 2024, I showed some graphs showing what's your projections for 2025, and they were all like really high. Well, now that we've been going down, see what's been happening to these projections and with all these different firms out here that have all these experts, they're lowering their forecasts for the S&P. And what's going to happen if we start to go back up? They'll raise their forecasts again. These guys blow with the wind just like everything else. Okay, then gold is really one of the best performing assets, whether you compare it to cash, bonds, or stocks. It's outperforming right now. Set another new all-time high this past week. And FactSet has some data here because we're right in the middle of earnings. How much of an impact do the Magnificent Seven stocks have? Quite a bit. That's this blue area here. They account for a lot of the earnings for the S&P 500, where the rest of the companies are, it's quite a bit less. But when you look at this, and we go back to 2023 and into 2024, you can see the discrepancy between the two. The mega cap stocks, the Magnificent Seven, they were up where earnings were down in 2023, and they really outperformed in 2024. Well, so this is coming down here. They're still outperforming, and even looking out into 2026, they appear, at least on a forecasting basis, that they will outperform then too, but they're not as high as they were before. And that's why I say that we're positive with earnings, but we're really coming down with the projections that we had been seeing. And then so far, as of Friday, 36% of the S&P 500 companies have reported. 73% of those are above their estimates. You know, they come out and they say, this is what we think it'll be. And then they report and they purposely lowball this. So they're hoping to get some kind of a pop out of the stock. And it's just a game that goes on here. But we're only about a third of the way through all the S&P 500 companies. All right, here's the intraday chart. Things were not looking good on Monday. We came down here and we just kissed 5,100. But then near the end of the day, we saw some buying coming in. It's the smart money who closes the market. It's the amateurs who open the market. And we saw some buying coming in here. And I saw this at the time, but it's like, okay, we're pretty negative right now. Well, then through the night, the futures were positive. We were able to gap up. We went up looking pretty solid here. We fell back and then closed not too much off of the high. Okay, showing some improvement, but we're kind of back to where we were the previous week, the day before Good Friday, which happens to be Thursday. Then things started to get really positive during the night. Now, Wednesday was actually a positive day, but if you just look at the price action for Wednesday and you remove the gap higher, this was actually not very positive. We gapped up, we went up, we hit this R3 resistance level, and then for the rest of the day, we saw selling going on. That's not very positive. We closed below the open. And so it's like, okay, we had an up day that day, and some of our charts actually showed some improvements, but this isn't all that constructive looking. When it really started to shift was Thursday. We didn't have much of a gap from Wednesday's close to Thursday's open, but we saw some pretty good buying coming in, taking us above these resistance levels and closing pretty much at the high. This is when a lot of the long-term indicators that we have started to go, we're turning positive now. And some of the things that were seeing weakness, suddenly we're seeing more strength. And then we were able to carry that over into Friday. We had a choppy open here, but we were able to go up to this R1 level. We fell back and then we closed at R1. So even though Wednesday looked like it was the most powerful day, really the strength came on Thursday. And then we were able to see some carry through on Friday. Are we going to be able to see any carry through on Monday? That's the question we're trying to figure out right now. So for the week, all of the sectors for the 5 trading days ended up being positive. Excuse me, all of the indexes ended up being positive, with the NASDAQ and NASDAQ 100 leading. And we had the NYSE. Even the bloody small caps were up and the mid caps were up too. But if we go back to the beginning of the year, all of the indexes are still negative, including the NYSE, which has been holding up better. And we still have small caps, which are doing the worst right now. Looking at the sectors, since we had an up week, I sort this based on what was up the most. And this is very encouraging, at least for right now, but this could change. Discretionary, tech, and communication. These are the three growth areas, and they were up the most. Some other areas that had been doing better lately, which are more defensive, they ended up being down on the week. So this is encouraging. Now, going to the next chart, this is a little less encouraging. None of these sectors over here on a scale of 0 to 100, we need them to be up in the high 80s, low 90s to show they're really strong. The best sector right now, which is communication, so that's encouraging, but it's coming in at 73. I mean, it's not showing an awful lot of strength there. And then we have tech, which is now coming in, you finally got up to 21. It had been one of the worst performing areas. And then we look at discretionary here, which is a little bit over 50 at 56.9. So, I mean, none of these are showing an awful lot of strength, but they are improving from the scores that they did have. So, that in and of itself could be taken as positive and rather encouraging. But when you look at how the sectors performed throughout the 5 days, we had tech and discretionary. That's what we want. Now, a little bit further behind here was communication. They were down just a little bit, and then all the other sectors were negative. And then going back to the beginning of the year, though, tech and discretionary are the worst performing sectors. They've got a lot of making up to do. They can't just be up for 1 or 2 days. We need to see some more follow through if this market is going to turn back and become more positive. All right, then looking at the relative rotation graph, and I am going to be doing some more research about this to see if there's better ways I can use this particular type of study. But this looks at the 11 sectors that make up the S&P, and you can see a lot of the defensive areas, and I have them all listed over here, their symbol and then what particular sector they're in. But we're seeing a lot of the more defensive areas showing an improvement where the growth areas have been lagging. And we're kind of mixed up right now with this. And then, so the areas that are in green, those are the ones that are showing an improvement. We have the yellow areas, which is more neutral, and then tech and discretionary, they're still negative, with materials showing a little bit of improvement as well. The indexes, we still have the S&P holding out a little bit better because it's a mix between growth and value. So it's actually improving, and it was up on the week. Utilities have been screaming on. That's more defensive, but you could also make a case that it's growth because of AI and Bitcoin and crypto mining and electric vehicles and all that, that maybe utilities are actually back into the growth area, but typically they've been more defensive. And then we still have the NASDAQ 100. It's improving, but still, now this is over the last year. It's still been declining with the mid caps, small caps, and transports not looking very good. And this shows it in a little different way where we see the S&P, the Dow Jones Composite, which is the Dow, the transports, and the utilities. And most of this strength is coming from the utilities, which is the utility part right below it here. And so that's showing some improvement with the big stocks in the S&P 500. That's the S&P 100. They're a little more neutral, with the negative side being more growth areas like the NASDAQ 100, mid caps, small caps, and then the transports, which have just been struggling. Sentiment, we're up. Believe it or not, we thought we'd never get back above 25 ever again. We actually closed at 35 in Friday's session, where we spent a lot of March and pretty much all of April below 25. We usually come down, freak out, everybody goes crazy, and then we bounce up out of this. Well, we came down here, everybody's freaking out and going crazy, but they're staying down here. It's lasting. The insanity's been going on for longer than usual. But we are now improving. This is actually more positive. We tend to go with the direction that this line is going in. We would turn even more positive if we get above 50. And who knows if we'll ever make 75 again. But this is looking a little bit better from a sentiment perspective. The active asset managers, and you pronounce this name. I watched a video over the week, over the some point during the week, and somebody from this organization was talking, and they actually called this name. I just call it active asset managers. They had been extreme negative, but we're starting to bounce up a little bit. But this is about a week old. It doesn't include Thursday and Friday's action. The latest reading that they're showing is at 40.67. We are coming down with the VIX, but we're still above 20. So even though it's declining, that's positive. The fact that we're still above 20, that's negative. And we are coming down a little bit here. When this black line is going down, that's actually positive. That means tech is outperforming cash. Well, we were seeing just the opposite of that here through March and into April. Well, now this black line is coming down, but we're still in this red cloud now. So we need to see this continue to fall to be more positive. And these poor folks with the right X bear bull ratio, they're getting jacked all over the place. They're getting into the bearish fund. When we get really high readings, excuse me, when we get really high readings like this, that means they're in the bearish fund. When we get really low readings, that means they're in the bullish fund. Well, they're just all over the place here. And we have an up day, they go bullish. We have a down day, they go bearish. And then we're flip-flopping back and forth. So this is all over the place. And for 9 weeks now, individual investors have been extreme negative. Now, that's probably going to change in the upcoming week because this is a week old. And now that we're seeing a little bit of a bounce here, the individual investors who tend to react to what happens, they're probably going to improve. That's just a guess on my part. We'll have to see what happens there. We're still getting a high reading with the Ulcer Index, and we're coming down on the daily chart, but we're still above the moving average. This is another fear gauge. And we are improving a little bit with the risk when we look at the spread between risky and not as risky bonds. This coming down is actually a good thing. Now, the next chart is an inverted version of what you just saw to match up with the S&P. Also have an inverted version of the VIX. This going up means fear is decreasing with the spread between risky and not as risky bonds. We want that. We were getting concerned because fear was really starting to rise as bonds were going crazy. Now they seem to be stabilizing a little bit. Now, we never got to really, really fearful readings like we've seen before, but we were sure headed in that direction. This is actually a little bit positive. And then we see that the VIX is outperforming the 3 month average of the VIX on a ratio basis. That just means that we weren't very volatile and now we're really volatile. And that's why this red line's going up. But this has actually been holding up. This is a 253 period moving average of the equity put call ratio. When we really get set to turn negative, this line goes up and it continues to go down. And we flattened out a little bit, but now it's starting to go down again. So this is still hanging in there somewhat positive. We're looking okay here and actually ticking up just a little bit with the weekly economic index. This isn't falling off a cliff, at least yet. The latest reading of the national financial conditions, we're still below the black line. That's good. We get nervous if it goes above the black line. Now, this is where we see this contradiction because the Atlanta Fed, they're still coming out with a negative GDP. We're going to get another read on GDP this week. So they're down here and minus 2.5% or something. And then you see it here on the GDP now chart where positive all the way. They're expecting it to be negative. So we'll see. We're going to probably learn more about that. But then you look at the New York Fed and they're positive. They've actually been going up. They're at 2.72% with GDP. So go figure. As I've been saying over the last few weeks, do we split the difference? And that means that we're pretty much at zero right now. We don't know. This will be updated again after the employment report comes out. This I'll also update if it really changes. This is a blow up of a chart. The chart that I usually look at, it's a lot, it doesn't look this good. So it really hasn't changed. We're not really getting up to this black line or this red line. This is trying to see what are the probabilities that we're going to go into a recession. If this really climbs, that means the probabilities are rising. And then the Bray Butters Kelly leading index, this is quarterly. The last that was updated was at the end of March. This coming down is actually a good thing. Usually when this is really going up, that's when we start to head into a recession. We did go up this last time, but we didn't go into a recession. As far as inflation, we'll get the core PCE later in the week, and then soon will come CPI again here too. But inflation doesn't seem to be moving around all that much. Now, I couldn't update these. The Fed website is down. So these charts are a week old. It just says service unavailable. They were doing some kind of maintenance. So I just have to go through that. We are seeing where the Fed balance sheet is continuing to decline, but on a year-over-year basis, it's still going up. And that's not really a surprise. The big one that we're watching is that we're declining here because in June of 2022, this is when we topped out, and the Fed came out and said, we're going to start to decrease our balance sheet. Well, then we started coming down, and then you had Silicon Valley Bank and Republic Bank. Well, that boosted this back up, but then it's now resuming its decline. Okay, we're not really seeing anything out of the ordinary here. This mainly applies to banks and their overnight lending. We're not really seeing any kind of real crazy movement right now here. That just tells us things are okay for the time being. Now, when we look at the advanced decline line on the weekly chart, we did come down to the moving average a week ago, but we're bouncing back up. We never did come down to the moving average based on price. So that longer term, this is still holding up and positive, but this is where we're seeing some weakness. If we were really getting ready to go up, we would see a lot more green going up than what we're seeing right now. The reason why this 4-week and 10-week moving average are going up, it's not because the green line's going up, it's because the red line's basically going down. There are fewer new lows, and the moving average is picking that up and treating this as somewhat positive, but it's really not showing any strength. We declined a little bit, but we're above zero with the 19 and 39 week advanced decline ratio. This is where we're still negative. This is the condition of the long-term trend on the weekly chart where the ADX, that's the black line, is going up. It's above the moving average. That means a strengthening trend. We're also above 20, which is this blue line, which means, yes, we are trending. And then we get the direction from the red line is above the green line, but the red line's coming down, but it's still far, far away from the green line. We're going to have to see some real improvement for this to turn more positive. We're still below zero and negative with the Arun, meaning sellers are still more in control than buyers. We're waiting to see on the daily side. We're getting a mass index signal, possibly very soon. We could get one here, but we haven't met all the criteria yet. And then this is a daily chart showing how we're in a downtrend since the 50-day moving average is below the 200, and we haven't even been able to come back up. And you can see we're kind of at the high end of this range. We came all the way down here, dropping below 4,900. We hit some really long-term support that I'll show you. Spent a very short period of time there and have been trying to improve, but a choppy improvement along the way. And we're wondering, okay, we filled a lot of these gaps when we were coming down. Are we going to be able to continue to go up now? And this is smart money indicator number one, accumulation distribution. We're above the moving average and going up. That's positive. Smart money number two, though, is negative. This is the Chaikin money flow. We're improving with the histogram, but the red line's still going down. And we're coming up and actually turning a little bit more positive here with the Chaikin oscillator. This is smart money number three. So we're seeing a bit of a mixed picture currently with this. And we turn positive on the daily side with the vortex, but we're still negative here. The red line is above the green line, where we saw the green line cross above the red line after Thursday. And then just looking at the S&P with a 50-week moving average, we're coming back up, but we're still below this red line. And then we look at the moving average crossover, where we're in danger. We've already crossed below on the daily side, but we're in danger of this blue line crossing below the red line. This would be a long-term downtrend, not necessarily a bear market, because we're less than 20% down from the all-time high, but this is certainly not positive. And so we need to see price really catch fire here, go back up and negate if there's a death cross that we see here. This is encouraging and discouraging at the same time. We're still above this S1 pivot point. That held. We broke below it, but then we were able to get back above it. That's the encouraging part. The discouraging part is we're still below this P, which is the pivot point. If we can get back above this, and that's at 55.75, but this is a weekly chart, so we need to be at 55.75 by Friday and then close above that level at Friday. We could go up and then come back down, but we want to be able to close above that for this to be more positive. We're above the midpoint of this trend channel going back to 2009. That's positive. We're above zero and going up with the McClellan oscillator, showing a little bit of an improvement with the summation index based on price. Still slightly negative based on volume, but improving. And we're seeing this on the daily side and here on the weekly side. The bullish percent indexes, even when we were seeing some weakness, we saw some buying coming in here. These are point and figure buy or sell signals. When we were just cratering down here, those were point and figure sell signals. When this is going up, that means there's point and figure buy signals. And we crossed above 50, and we're looking really quite positive with this chart, not only here on the weekly side, but on the daily side. And the swollen trading oscillator, we're above zero and advancing based on price and volume. That's positive. We're trying to improve as far as momentum, but you can see the PMO just tanking, as are all of our momentum oscillators that I'll show you. We're a little bit above zero based on price. We're a little bit below zero here based on volume. Seeing some improvement with the PMOs. These are all the PMOs inside of the S&P 500. This is a study of all those stocks. We're seeing an improvement here with the PMOs that are rising. The buy signals are still improving, and we're going up here with the PMOs that are above zero. And we're improving with the Bollinger Bands, the percent B, but we're still below the midpoint. But at least we're inside of the Bollinger Bands now. This is a momentum. Short, intermediate, long term, we continue to go down. Copy curve, another momentum oscillator, negative. Improving, but still negative with the force index. Improving after getting an extreme negative reading here with the money flow. And coming right back up just below the midpoint with the Stochk RSI. Coming up a little bit above the midpoint with the Williams percent R. So you can see how things are improving, but not really full-blown positive, at least yet. A little bit below the midpoint with the ultimate oscillator. This is encouraging too. The RSI came all the way down, gave us an extreme negative reading. It's still below 50, but if it can get back above 50, because notice it spent all of 2024 above 50. And now we've dropped down to below 50. If this can get back up into this range, that would help things longer term. 1 week over the previous week, we had a solid up week compared to the week before. We're seeing a bit of an improvement above the midpoint here with the rate of change going back 50 weeks. This is in danger of turning negative, but it isn't quite there yet. We are negative on the daily special K chart. We're looking weak here with the weekly special K chart. This is the long-term support that I was talking about. These are Fibonacci retracement levels from the October 2022 low to the February 2025 high. We gave back half of that. We came down here and just bounced right off of that. That's a very good sign. We don't know what kind of upward move, what it's going to be like. It could get really choppy and we could actually see some declines. But for right now, this really, really important support level has held. And that was actually a few weeks ago when that happened. We're looking a little more positive here. When you see these candles like this, they're more doji looking. A doji is candlestick patterns where you have the open and the close just about at the same point. And we're seeing two little dojis right here as the market could be trying to turn a little bit more positive. We're negative since we're red with the Kegi chart, but we're pointing up. So at least it's picking up some positive action there. We're still negative with the Renko chart, and we're still negative with the three-line break. So we're not seeing any kind of real confirmation across all our different trend charts that we look at. We're improving a little bit here, but still quite negative with the ease of movement. We actually crossed positive on the daily side, and we saw enough of an upward move here to put in a new green X this past week. And this is a low pole reversal. The pole was the zeros going down, and now we're sliding up the pole over here as we're going back up. Okay, so that's improving. And we're seeing some weakness here. This is a weekly chart of the PPO, another momentum oscillator. We're in danger of actually crossing below zero here with the long-term momentum, but we haven't done so yet. We are already below zero, but now trying to improve in the intermediate term, and we're actually turned back to positive here. We're above zero with the short term. All right, then we are neutral with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR weekly chart, where we're positive with the daily chart. And then in the short term, we're positive across the board on all the different indexes. We're negative in the intermediate term, and mid caps and small caps are negative in the long term. And we're seeing a little bit of a downward move with commodities in the short and intermediate term. Bonds have turned back to positive in the short term, but the dollar is negative on all time frames. And we just look at the S&P here and we see where the mid caps have been underperforming and the small caps have even been underperforming that overall. We just look for any kind of divergences here. And we're still below the 13-week moving average and the 50-week moving average here. If we don't get back above these lines, we're looking at a possible negative trend for the Dow. And we're starting to see a long-term negative trend with the NASDAQ. We're seeing a death cross here. The NASDAQ 100 also seeing a death cross here. Mid caps already in a death cross. Small caps way beyond a death cross here. Like bury them twice. And then this is a daily chart. We're seeing the Wilshire 5000, a broad market measure, which is in a downtrend here. The NYC holding up a little bit better, but we need to get back above these lines to have it improve. All stocks, we're seeing a bit of a bounce here. These are US and international stocks. The trend's still holding up for right now, but that blue line's really starting to get close to the red line. The FANG index, we're generating a death cross even after Friday's session on the daily side. We are showing some weakness here, but we're seeing a little bit of a bounce up above the 50-week moving average, trying to get back up to the 13-week moving average. Those are the really big stocks. ARC trying to get back up to its 50-week moving average, but it's getting taken down with everything else lately. April is supposed to be positive if you go back over the last 5 years, and we are improving. We were down a lot more than minus 1.6%, so at least we're showing some improvement there. And after getting really extreme negative with the bank index, we're starting to bounce up with the RSI. This again is a weekly chart, but the momentum is still negative. And then we look at traditional Dow theory, which is just the Dow and the transports. I also add utilities, and that's really been holding up. The utilities where the transports just really not coming down. Even though the Dow has really been declining, you can see how the transports have really been coming down a lot more. Then looking at commodities, still in an uptrend, even though they've been pulling back. Oil's really kind of been behaving itself. It got into the low 60s. Now it's working its way back up to the mid 60s. And that will help the inflationary fears if it can stay down. Gold coming off of setting an all-time high. Silver is also in an uptrend, but has a ways to go to set an all-time high. The dollar on the daily side and here on the weekly side, downtrend and below 100. Copper, though, this is encouraging. Copper is a barometer of the economy. On the daily charts, we're in an uptrend, and here on the weekly charts, we are in an uptrend. That's encouraging economically. And we look at bonds, they're still in an uptrend based on price, and we're seeing a little bit of an improvement here with the monthly chart of the stock to bond ratio. We were further below this blue line. We're actually closer to this blue line now. And here's a daily chart showing how the yields were coming down, and then we had that crazy week with yields just jumping up. Now they seem to be coming back down again and stabilizing. And then we look internationally at a weekly chart with the US and UK rates. The highest German rates are in blue, and Japanese rates are in red. Right now, they've been all dropping down here. Then we look at the intermarket analysis chart, where gold is the best performing asset if you go back to the beginning of 2025. In second place are bonds based on price, and in third place are commodities. This is a new addition to this chart. And then after that, it's stocks. That's the black line that we see. Then the dollar, and then oil is now the worst performing area of the market year to date. Looking at our NASDAQ 100, which is growth, and comparing it to the S&P 500, which is growth and value, seeing a bit of an improvement here, but we're seeing an overall downtrend with the NASDAQ 100 underperforming the S&P. NASDAQ 100 still in an uptrend compared to the rest of the S&P, but it's trying to make a comeback here. Growth still in an uptrend compared to value. Really weak, trying to get some strength coming back in here. That would really help the market. And then gold, it was off of its high, and the S&P ended up going up, so we came down a little bit with this ratio. And gold's really been outperforming the dollar because the dollar's been going down as gold's been going up. This is longer term too. Bonds are now starting to outperform stocks on a ratio basis. Now, we are pulling back right now, but we'll see if this uptrend will continue. And then low volatility versus the S&P 500, it's been outperforming, but lately pulling back. Discretionary to staples. Discretionary was outperforming, seeing a lot of weakness, trying to bounce back up now. And then energy, kind of chopping around here. When this is going down, that means tech is outperforming. Well, this really started to go up, meaning energy was outperforming. Now we're coming back down here. We're just kind of dancing around these moving averages. And both small caps and tech have been not doing very well lately, so this ratio is going sideways. Then here's the NYSE breadth thrust. This is just a regular way of looking at this. I use this like an oscillator when we get an extreme negative reading, which we didn't get. This is the one that's creating a bit of a fuss. This is the Zwag NYSE breadth thrust. This was found by Marty Zwag, somebody, one of the very first books in the late 80s, early 90s that I read about the stock market. And he did all this kind of research. And when we drop down below this zero point 0.4 level and then come back above it, we have to get up to this red line, which is 0.615 within 10 trading days. Well, there was some debate going back and forth on X or Twitter that, oh, maybe it was just short covering. You wouldn't see a really strong reading like this if it was just short covering. There's not enough of it out there to really make this big of a difference. So I'm treating this more as legitimate and as a valid signal for right now. And this, you can look when we had other signals here, what the S&P didn't mean it went straight up, but it did look pretty positive after that. So this could be a good start if the market's getting ready to go back up. And we're still above this long-term trend line with the S&P weekly chart going back to the 1987 crash. Here's a look at that where we were able to reclaim that trend line. This is a little bit negative. For a long time, we've been at a 10 here with the Zohorchak method. We actually came down to an 8. Now, it's still positive. It doesn't go negative unless we drop below 0. But we'll need to see this get back up here to give us a full-on buy signal again. And got a lot of damage to repair here with the NASDAQ 100. We're still below this trend line going back to 2009, but this ratio is holding up. NASDAQ 100 growth, Dow value with some growth thrown in. We're above this red line. That's positive. The Qs, NASDAQ 100 to small caps, IWM, going up. This is holding together for right now. We're still negative, but improving when we look at the 50-period exponential moving average of the new highs minus the new lows for the S&P, as well as the new highs and new lows for the NYSE. So it's bouncing, but still negative. Not really concerned about this. We're seeing the 3-month yield just going sideways. We don't want to see something like we saw in late 2007 going into 2008. So this can be nice and calm, and we're okay with that. And then we look at a longer term chart here, the cumulative new highs, new lows for the NASDAQ, which have been going down. Seasonally, got a lot of work to do if we're going to get back to something positive. We got a few days left in April to see if that's going to happen. And we're also ending the best 6-month period. My goodness, what are the worst 6 months going to look like if we go seasonal tendencies here? We're in the second half of April, which typically performs well. Just don't ask 2025 about it. And then when you look at this, all different kinds of ways, going back to 1950, April is usually one of the better performing months of the year, except this year. So thank you. I really hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.